Under his stewardship, the chairman of the MPC, Weah, someone, the bank has strengthened policy credibility, enhanced macroeconomic stability, and reinforced confidence in the financial system. Let me also recognize the contribution of our technical committee members of the MPC for their invaluable contribution as well as distinguished members of the MPC. Ladies and gentlemen, today's session marks a critical point in our policy process as we formally communicate the outcome of the MPC deliberations and policy stance that will guide equity management and support macroeconomic stability for the next quarter to sustain confidence in the economy. With these remarks, I'm delighted to respectfully welcome all as we invite the Executive Governor and Chairman of the MPC to read the Monetary Policy Committee decision. Distinguished representatives from different institutions and members of the MPC, I want to say thank you.
Thank you very much, Governor. Governor. That brings us to the high point of this event. Because the person who will be doing the reading is the chairman of the Monetary Policy Committee that made the assessment of the Liberian economy and come up with decisions, hopefully that will see us through the next 3 months. So I have the honor to present to you the Executive Governor of the Central Bank of Liberia and also the Chairman of the Monetary Policy Committee, who will take you through the monetary policy decisions that the committees come up with. Governor?
Thank you, Francis, and good morning, everyone. So before proceeding to the official reading of the communique, I want to join the Deputy Governor for Economic Policy to also formally welcome you, and I will go through this formal welcoming remarks with you. Members of the Board of Governors, led by Governor George Goody, members of the Monetary Policy Committee, Deputy Governors, and members of the Senior Management Team of the Central Bank of Liberia, Managing Directors of financial institutions, representatives of financial and other private sector stakeholders, members of the Liberian business community, members of academia, members of the Fourth Estate, distinguished guests, ladies and gentlemen. Good morning and welcome to the Central Bank of Liberia. It is my pleasure, on behalf of the Board of Governors, the Monetary Policy Committee, and the management and staff of the Central Bank of Liberia, to officially welcome you to the reading of the 26th Monetary Policy Communique. This communique reflects the careful assessments and deliberations of the Monetary Policy Committee on recent global, regional, and domestic economic developments, as well as the outlook for inflation, growth, exchange rate dynamics, and financial stability. It underscores our continued commitment to safeguarding price stability while supporting sustainable economic growth and maintaining confidence in Liberia's financial system. In an environment characterized by heightened global uncertainties and evolving domestic challenges, the Central Bank of Liberia remains firmly focused on deploying appropriate policy measures that are data-driven, forward-looking, and consistent with our statutory mandate. Today's communique provides clarity on the policy stance of the bank, the rationale underpinning our decisions, and the measures we will pursue to anchor inflation expectations, strengthen macroeconomic stability, and enhance resilience in the Liberian economy. We value transparency and accountability as critical pillars of effective monetary policy, and it is in that spirit that we engage with stakeholders through this public reading and subsequent interactions. Thank you for joining us, and I will now proceed with the reading of the 26th Monetary Policy Communique. Central Bank of Liberia, Communique number 26, April 30th, 2026, for the Monetary Policy Committee meeting held on Monday, April 27, 2026. The Monetary Policy Committee of the Central Bank of Liberia met on April 27th to review global and domestic economic developments during the first quarter of 2026 and to determine the appropriate policy stance, monetary policy stance. The committee's decision was guided by its mandate to preserve price stability, safeguard exchange rate stability, maintain financial system resilience, and support domestic economic growth. After thorough assessment of recent macroeconomic and financial conditions, together with the medium-term outlook and associated risks, the committee concluded that maintaining a cautious tightening bias remains the most appropriate course of action at this time. In reviewing the global economic developments, the global economy continues to moderate amid heightened geopolitical tensions, trade policy uncertainty, and disruptions in energy markets. The International Monetary Fund, the IMF, has revised its global growth projection of 3.3% for 2026 downward to 3.1%, reflecting the impact of an oil price shock linked to the ongoing conflict in the Middle East, which has disrupted global supply chains, intensified volatility in crude oil markets, raised financial stability concerning global uncertainty. Although global headline inflation has been on a downward trajectory, the recent surge in oil prices has renewed inflation concerns, prompting or compelling central banks to reassess their monetary policy stance. The April 2026 World Economic Outlook report shows modest rise in inflation due to oil and commodity price shocks arising from the Middle East conflict before declining again in 2027. Headline inflation is projected to rise to about 4.4%, largely reflecting higher energy and food prices, while core inflation remains elevated across many advanced and emerging market economies, suggesting a slower pace of policy normalization than previously anticipated. Consequently, equity market volatility and rising bond yields. These developments have reinforced safe haven demand for the US dollar and increased external financing costs for emerging market economies. Monetary policy actions across mixed movements with increases in rice and palm oil prices offset by declines in cocoa and coffee prices. On the domestic economy, the Liberian economy remained resilient with expansion in economic activity during the first quarter of 2026, consistent with the annual growth projection of 5.1%. The economy was driven primarily by mining and mining, agriculture, and a rebound in manufacturing and services. Sustaining this growth trajectory will require the continuation of reform efforts, reforms in fiscal policy, strengthening domestic revenue mobilization, and the continuing efforts in stabilizing the banking sector will remain a priority. The Composite Index of Economic Activity moderated slightly during the quarter but remained firmly expansionary, widened to an estimated 3.9%, signaling positive demand pressures entering the second quarter of 2026. Headline inflation moderated to 3.6% in quarter 1 from 4.4% in quarter 4 2025, remaining within the bank's single-digit objective. Core inflation was also contained. However, the committee noted emerging input price pressures towards the end of the quarter. This aggregated inflation data indicate that the moderation was driven primarily by declines in food and market prices, while administered price rose modestly by 0.7%, reflecting higher transportation costs. Inflation is projected to edge upward in quarter 2 2026 and remain in single digits to around 5.3%, with a bandwidth of plus or minus 2 percentage points, reflecting higher imported fuel and food prices and exchange rate pass-through effects. Inflation expectations remain broadly anchored, but the committee emphasized the need for continued vigilance. Financial conditions and monetary developments. The banking sector was generally stable, adequately capitalized and liquid. Capital rose by 10.6% to $53.4 billion Liberian dollars, while the liquidity ratio stood at 53.2%, sufficiently above the 15% minimum requirement level. However, non-performing loans, NPLs, remain elevated at 2.98 percentage points above the regulatory threshold of 10%, constituting a key financial stability risk. Total non-performing loans amounted to $13.5 billion in quarter 1 2026, with US dollar denominated NPLs accounting for the bulk of the NPLs. Total banking system capital rose to $53.4 billion, equivalent to $288.72 million United States dollars. Industrial liquidity and capital ratios remain above regulatory minimums, with all commercial banks meeting the minimum requirements. Broad money was broadly stable at about $289 billion, reflecting a marginal decline of 0.1% in net domestic assets from end December 2025 that offset an increase in net foreign assets. Currency in circulation and narrow money declined, while quasi money increased, indicating a continued shift towards time and saving deposits. Total loans and advances increased modestly by 1.6% to $104 billion, equivalent to $562.28 million US dollars, with rise in Liberian dollar loans, while US dollar loans declined. Credit remained concentrated in trade, personal and services subsectors, with limited financing to agriculture and construction. Average lending rates were largely unchanged, pointing to partial monetary policy pass-through. Domestic financial markets functioned effectively, supported by the effective operation of the interest rate corridor framework, active interbank trading, and CBL bills operation geared toward net liquidity absorption. The Monetary Condition Index, MCI, remained accommodative, reflecting expanded US dollar liquidity, warranting continued policy vigilance. Fiscal and external sector developments. Government revenue improved in both currencies during the quarter, though fiscal deficits persisted, howbeit narrowed in comparison to quarter 4 of 2025. The committee reiterated the importance of fiscal consolidation, prudent debt management, and strengthened coordination with fiscal authorities. On the external front, export receipts increased, driven by gold, iron ore, and round logs, while input payments also rose, narrowing the trade deficit. Net remittance inflows remain supportive of foreign exchange supply. Gross international reserves increased to approximately $722.5 million, equivalent to an estimated 2.9 months of input cost, slightly below the conventional 3 months benchmark, but above the 2.5 months recorded in Q4 of 2020, by about 2.9% on average during the quarter, underscoring ongoing external vulnerabilities and the importance of continued reserve accumulation. Risk assessment and outlook. The MPC's heat map assessment shows that risks skew to the upside for inflation and downside for growth. Key risks include elevated global commodity prices, especially fuel and imported food, tighter global financing conditions, renewed exchange rate pressures, high dollarization, elevated non-performing loans, and potential fiscal challenges of increasing expenditure demand. The near-term outlook remains cautiously optimistic, but subject to risks from both external shocks and domestic policy slippages. Policy decisions. Considering these developments and after rigorous deliberations, the committee resolved to 1. Maintain the policy rate at 16.25% with a continued cautious tightening bias. 2. Maintain the reserve requirements at 25% for Liberian dollar deposits and 10% for US dollar deposits. And 3. Maintain the corridor at plus 2.5% and negative 7.5 percentage points around the monetary policy rate for the standing credit facility and the standing deposit facilities, respectively. The MPC reaffirmed its commitment to leveraging the CBL bills, outstanding facilities, and targeted liquidity operations to manage short-term liquidity and support monetary policy transmissions. The committee will continue to closely monitor developments in the Middle East and its potential implications for the inflation outlook, and assures the public that in its commitment to achieving the core mandate of price stability, it will remain proactive through a data-driven policy response should price or financial stability risks materialize to safeguard price stability. Let me conclude by quoting: "The stability today is the foundation for growth tomorrow, and the Central Bank of Liberia will continue to act responsibly in the best interests of all Liberians." End quote. The next regular meeting of the committee is scheduled for 15th July 2026. Thank you for your kind attention, and we will now begin the interaction, as there are other very important issues that are currently trending, and myself and my team here will be open to addressing some of those concerns. Thank you very much.
Thank you very much, Governor. As the Governor mentioned in his opening remarks, this event is inspired by the need for transparency and accountability on the part of the central bank, and also to anchor inflation expectations within the Liberian economy. It is because of this that we will take this very message to the public as of tomorrow to ensure that there is transparency in the decisions that we make to prevent any speculations. But for now, before going to the public, we'll begin here with you to get your feedback, because here within our midst, you represent a cross-section of the economic actors within the Liberian economy. So we'll begin. We have here with us financial institutions represented. We have the private sector, we have civil society, and we have the media. But we'll take feedback from financial institutions. The mic is here.
Thank you. Governor, thank you for having read the communique and presented to us and the public the position of the NPC on the prospects of the economy. A couple of things I'd like to comment on. First, like the moderator said, every time I do these meetings, I'm struck most by the level of introspection that went the policy make a decision. So it's not like somebody just arbitrarily deciding, let's keep the rate at 16.25, let's increase the rate to 17.65, or let's decrease the rate to 15. You can see the level of introspection that went into the decision-making process, and I think that's extremely important for the level of accountability that you seek to achieve. Second thing I want to talk about is what is an apparent inherent contradiction in the statistic rates that we read earlier. We talked about one, the banking sector being adequately capitalized, way above CR ratios, minimum ratios, way above minimum liquidity ratios, but then just a 1.6% increase in loans. Let that sink in for a second. The banking sector is extremely capitalized. The banking sector is liquid. That means it has unused absorption capacity. Yet the extension of credit increased by 1.6%. Something has to be wrong. And that goes to the fact you pointed out earlier about the non-performing loans. So the banks have the capacity to extend credit, especially to the unsure sectors that you talked about. You talked about the agricultural sector, the construction sector. The banks are concentrated in retail and trade sector. And that all ties back into the level of underperformance in the loan portfolio that banks have experienced over the last several years with respect to the sectors you mentioned specifically and other key sectors. So it seems to me, so it suggests to me that we have the leverage point to apply the pressure. But if we have identified the leverage point, are we supposed to apply the pressure to increase the numbers that we talked about earlier? And that is the issue of performance of loans in the industry. That is we had the same conversation in the last NPC meeting and the one prior to that. But yet the solutions have not yet been reached. And the solutions are far from being implemented. And the effect that it has on the banks and by extension of the public is reflected in the numbers that you just read. Just a 1.6% increase in loans extension. So I'd like to encourage you, and I know there are already plans on the way for this NPL conference that we talked about at Los Angeles for the last several meetings or so, and that's pretty much close to fruition, that we now have identified where the problem lies. If we were to apply the pressure that we need to apply on that one surface area, the issue of non-performing, that will resolve to some extent. The numbers that the government just read would be inconsequential compared to what we can achieve, or what we will achieve if that issue were resolved. So I just like to encourage us to keep our fingers on the pulse of the industry and ensure that this conference that we keep talking about, that's going to come with the NPL conference, that's going to involve a wide range of stakeholders. It's not just for show that we had a conference, everybody showed up, everybody spoke, everybody expressed their view, but then there are consequential results from this conference. So that the impact is going to be felt downstream by the customers of the banking industry. So let's make sincere effort to resolve this issue, because this is the one issue that's holding us back. I had my shareholders meetings yesterday and the day before. Same thing. I got the same question from shareholders. Why are we concentrated in the trade and retail sector, especially LBD as a development bank? Your core mandate is this. Why is your loan portfolio not skewed towards supporting that mandate? It all boils down to that. And I said to them once they into our shop, our experiences with respect to non-performing loan, not just me, but every bank in this room, I suspect I speak for, means that we got to be twice as careful in the granting of loans. Just to ensure that at the onset of the granting of loan, there's a greater chance of recovery than not. Now, so in the process of doing that, there's so many strong prospects, there's so many projects that we actually should be supporting, but that are affected by the general environment that we find ourselves in. So people who generally need loan, who generally have the capacity to repay, they're affected by those who already have loan and have not repaid. Because now we have the twice as careful as normally would be a granting facility. So I suspect if we were to focus on this issue of non-performing loan, attack this conference with the level of seriousness that it requires, with the hope of achieving concrete, measurable objectives, we would have solved 80 to 90% of the problems the banking sector faced. So I'd just like to encourage you and your team, Governor, for us to keep that focus in mind, to ensure that this conference achieves the objective that it intends to achieve, and that we make the progress that we need to make. All right? Thank you very much.
Thank you, Emily. Let me just respond to that very briefly, and to give the Liberian people an insight of what the situation that the MD just mentioned really is. The Liberian banking system, we indicated, is relatively stable. One of the risks we have is the situation of NPLs. But let me say to Liberian people that are only thankful to the Liberian banking community for steps that they have taken and are continuing to take to reduce the level of high NPLs. As at the beginning of 2025, NPL levels in this economy was at 21%. Today we are at 13%. It's a significant improvement. The challenges still remain. And we need to address those challenges. That's the essence of us deciding to have this conference to bring together all of our stakeholders. As of today, or as of yesterday morning, the excess balances that we hold for all the commercial banks in the system, excess over their statutory reserves, in terms of US dollars, was $106 million US dollars. Excess over their reserves. The reserve position, what they are supposed to keep with the central bank as reserve, as at the beginning of the day yesterday, I was still waiting for today's report, was supposed to be 111 or 112 billion. That is what they are supposed to keep as at yesterday, based on the average balances of deposits that they are holding. But yesterday, the central bank was holding 218 million for the commercial bank, an excess of 106. This is not any assets for the commercial banks. It's just sitting there. They can do nothing with it. No money. They're not making any money on it. Nothing. But they cannot deploy these resources in the real economy. Why? Risk aversion. Risk aversion. Because of the situation that the commercial banking system has experienced with high NPLs and the system, the response of the system to their concerns. And that's the reason why we want to have this conference and bring all stakeholders together. Let us try to address this devil. and see what is causing this situation in our economy that is stifling growth. Can you imagine if the commercial banks today deploy 106 million in this economy? Can you imagine the impact that would have on our domestic economy? It's quite significant. But they cannot because the system is not helping them. These commercial bankers want to be ensured that if they deploy these funds, they can recover in time. Because these are depositors' funds. These are depositors' funds. So if one customer comes and deposits the excess in the commercial bank, there is somebody who is actually in need of that excess. But because of the situation that the system faces right now, the bank is saying, you know what, wait a minute, I will just hold it for you. I cannot deploy it to spur growth in the economy. So it needs a whole government approach. The executive, led by us, the central bank right here, the judiciary, very, very critical and key, and the legislature. Because some of the laws will need to be amended so that the central bank of Liberia can also act and act decisively to protect this economy, to protect the banking system, to help to create jobs, to expand this economy, and help to create jobs. What this is doing right now is that there can be no job creation that can be supported by the commercial banking system. Because they are afraid that if they deploy these funds to create jobs in the economy, they cannot recover. And then we, the central bank, as the other regulator, will go back to them and say, hey, provision, write up and go ask your shareholders to bring in additional resources. Like I always jokingly say to my team, these shareholders don't have trees that they pick money from. No, these are hard-earned savings that were put together to invest in the Liberian economy, and they need return. If they can't get returns on it, at the best minimum, they should be able to get their capital. That is the intent. And so it is our collective responsibility, all of us, the government, the citizenry, for us to address this particular situation. If we want to see growth and development in this economy, we have to address the situation of NPLs in this economy. Thank you.
Any other comment from financial institutions? No. Yes? Financial institutions?
Yeah, first view.
Okay. From Nafibo?
Thank you, the government. Thanks to the management. Seriously, how we need to bring out stagnation, but it cannot go back to the bank for deposit. And the huge custodian of these coins are people that sell water, gas, and they have these coins sometimes go and carry coins in bulk and take it to business centers and find out that businesses don't receive those coins from the people that also are true coins. So I just want to bring this to your attention, see what we can get from it, and see how better the coins in full circulation. Thank you.
Thank you for that concern. I think we have addressed that situation with the commercial banks, and so probably we will have the commercial banks to respond to that and tell you what they are now doing. But the coins are not accepted for deposits.
Yeah.
No, we had a meeting quite recently on this matter. I think in the same boardroom, and a wide range of issues were discussed. One of the key factors that we propounded from our side of the table as banks was that we thought that the need or the directive for the CBL for us to issue a portion of people's withdrawals in coins had to be in lockstep with efforts by the CBL to conscientize the public on the acceptability of the coins. People's psyche generally shift towards, and for many years that's been the case. I mean, maybe since 1990 or so, we've had just the currency notes. So people's psyches have shifted away from coins as actual currencies of transaction, and in their minds, and maybe every one of us in this room is guilty of that. I mean, subconsciously, right? As actual currency for transaction. So with our suggestion to the CBO, while we accepted the mandate from the CBO for issuance of coins with respect to 1% of withdrawals being given in coins, and banks accepting coins on deposit. We had a discussion and the banks were in lockstep with the central bank that needed to happen. But we also urged the central bank to start a massive campaign whereby people can be conscientized on the acceptability of the coins. It's just that side that has to be worked on. Once people start to use the coin as actual currency transaction, doing the transaction, there will be less need for them to bring it to the bank. Because as it is right now, people just collect the coins, stack them up until they have a bucket full, let's take it to the bank. And now, banks also have operational challenges with respect to dealing with coins. How do we sort the coins? How do we count the coins? If you brought a bucket full of coins to me for deposit, to the teller has to sit there and count those coins individually. And that's going to take a lot of time when the customers on the line will be served. So because of the operational challenges that we have, some of which have been alleviated by the central bank making available to us coin sorting machines. I think each bank now has 3. And we also made inquiries to acquire some on our own. So we expect that some of the operational challenges will have been resolved, and our ability to accept coins from the public over the counter will be made that much more easier. But to ease the pressure on the banks of people having to walk in our banking halls with sack loads of